This is Eric Muathe from Muathe.com with about 30 minutes to go before the end of session for the day and for the week. We can say the markets are unchanged for the most part. All right, let's take a look at those charts. We're going to begin with a quick follow-up to a video I did for paid subscribers on Thursday, and it is the NASDAQ weekly chart, where we continue seeing this line on the weekly RSI, and this is a 2-year weekly. This line continues to be where the RSI is putting a little bit of a pause to the current movement high in the NASDAQ. As long as, and again, this is a follow-up, quick follow-up as far as the NASDAQ is concerned, as long as we're below the blue line, chances are this market is setting the stage for a pullback or sideways action. What the bulls want to see is the market coming and taking out this blue line so that we can have continuation to the upside. So it's a simple, well-defined line. Above the line is very bullish, and below the line we can start seeing signs, very early signs of a market that is in need and due for a pullback. Let's not forget that we have RSI 69.1 showing uniform activity rejection, as you can see here. RSI 69.1 as of this week, and again, this is another indication of a market that is due for a pullback. And the only way to correct this, again, the market would have to move above the 69.1 threshold on the weekly chart. Keep in mind, on the monthly, as we pointed out, as long as the NASDAQ is trading above 69.1 on the monthly, and I should say this is the key takeaway from this video right here. So this is the main takeaway, the main point of observation. As long as the NASDAQ is above 69.1 on its monthly RSI, then we have a market that net is pointing higher. Yes, you can get pullbacks, but as long as we are seeing RSI 69.1 and above, this market remains stable to bullish. And of course, should the market reverse and drop below this number, then that in itself would send a message of a pullback as being the next potential direction in the market. Right now we are trading above 69.1, and again, in my opinion, this is the main takeaway right now in the market. As long as we are trading above 69.1, let's give the market the benefit of the doubt. And in fact, we can actually see a good indication of this just by taking a look at this chart. Go out about 5 years. You can see that there was a period where the NASDAQ moved above 69.1, which is the beginning part of 2017. And as you can see, the market remained net bullish for more than 1.5 years. So this period constitutes the NASDAQ trading and holding above the threshold of RSI 69.1. That's why I'm saying, as long as we are trading above 69.1 on the NASDAQ, the market still has bullish intent. Now you can see the pullback we had at the beginning part of 2020 coincides with the market showing uniform action rejection here back below 69.1, and that shallow pullback below 69.1, if you're sensitive to it, gave you an inkling, an idea, as a direction to be on the lookout for, which was a downside correction because of the RSI 69.1 rejection that took place at the beginning part of 2020 and also end of 2019. It's another way of saying, if we end up seeing another RSI 69.1 rejection in the NASDAQ, that's going to be a sign of a market that is due for a pullback. Again, back to what I'm saying here is, it's very simple. Let's just take our cues from how markets behave, and we understand this to be consistent. Whenever a market moves above 69.1, the best course of action is to give that market the benefit of the doubt and understand that as long as it is above 69.1, markets are going to see pullbacks, but net, the direction is going to be to the upside. If you're new to this concept, this is my own research method, and it is very simple and very reliable. If we take a look at the NASDAQ Daily, as I was pointing out on Thursday, as long as we are holding above this RSI lows line, net, the market remains stable to bullish. We would need a break of this trend line before we can see a massive plunge in the market. And that's just keeping it as simple as possible. Keep in mind, the most recent break in the market took place when we broke below a trend line on the daily RSI, which is this period here. So we need to see something similar before we can see any plunge in the market. And remember, as long as a market is holding net above 50, you tend to have a bullish phase. Above 50, you tend to have a bullish phase. I'm talking about RSI 50. If we take a look at the 4-hourly, and again I covered this on Thursday, as long as the RSI for the NASDAQ is holding this line, the market should continue being stable to bullish, and we can see even as of late Friday, market is holding support right there. So a break of this line is needed before we can see any major short-term pullback or major pullback at that. And again, this is necessary. It's a minimum requirement because you can see it's only when we broke below this trend line on the 4-hourly in the beginning part of the year, in February, that break is what brought the market lower. So until we can see something similar in terms of a break of this trend line on the RSI, don't expect a major pullback in the market. Let's take a look at the Dow. The Dow has a number we can use, and it is this recent weekly closing high from June. And the market, the Dow, needs to clear this level if it's going to see higher prices. And this level is at 27,110.98. A breakout is needed above this level if the Dow is to continue recording higher prices. Failure to clear that level does send a message that the market has run out of short-term bullish momentum. Taking a look at the Dow Daily, we come to this flattening out 200-day moving average. Again, the Dow has this flat 200-day moving average. Now, from last weekend's market analysis video for paid subscribers, I pointed out that this is something you're going to see in a lot of the charts. This flattening out 200-day moving average and an upward sloping 50-day moving average. This is something that can be seen in a lot of the charts across the globe. And because this is something we see across the globe, let me explain something here. So you got a flat 200-day moving average. You have an upward sloping 50-day moving average. So 50-day moving average. Now keep in mind, this generally comes from the 200-day moving average has been sloping lower and now is flat. And this is the key. Because it is flat and it's a major moving average, there's only one way to coil the 200-day moving average high. So the only way this can start moving higher, which is the 200-day moving average, is by a rapid, sustained day-to-day price expansion. At the same time, that would influence the 50-day moving average to cross over above the 200-day. And of course, that would be a bullish development. Now, for all of this to take place and play out, then it needs a breakout above the recent daily closing high. So keep that in mind. It needs a breakout in price above the recent daily closing high while we have this flat 200-day moving average. It's another way of saying that the only way we can get a future crossover between the 200-day and the 50 is by prices moving above the recent daily closing highs. This is something you're going to see across the globe, and this is a method that I call the Muathe Virgin Breakout. This method has been time tested over a period of many years and can give very powerful swing trade entry with high velocity and momentum. And of course, it also works on the way down, but that's a subject for another day. And so to save time, I'm just going to give you some of the charts that have this look. You can see a flat 200-day moving average as far as the Dow is concerned. We can see an upward sloping 50-day moving average. And so the breakout level is this recent daily closing high for the Dow. And that level for the Dow is 27,572.44. It would need to clear that level before it can advance above current levels and to ignite a major momentum period to the upside in the market. Now, as the market comes close to the end of the session, let's take a look here. A couple seconds to go before the close. We can discuss the two potential resistance lines on the Dow's daily. There's this breakpoint here on the RSI. And we take that information and draw our uniformity resistance line. Something like that. And this recently turned into resistance as far as the Dow daily is concerned. Take a look. Also, there's another way of looking at this in my point of view, which is the prior topside resistance line. And we can see that this line gave us a short-term entry or a breakout of some sorts here for this move higher. We did break below the line and we came back after a couple of weeks, and that continues to be resistance. So on the daily RSI for the Dow, we would need to clear these lines before we can move higher. Now, sticking with the daily, let's take a look at the S&P 500. And again, we see another example of a flattening out moving average right here. The S&P 500 also has a breakout level on the daily, similar to that of the Dow. This is something you're going to see a lot in many of the charts across the globe. And the S&P 500 would need to break out above 32.39, which is the recent daily closing high from June. On the monthly, S&P 500 would need to break out above December 2019's monthly closing high and stay above it for it to remain bullish. That's at 3230.78. So a breakout and holding above that is needed, while bears would be encouraged to see a failed monthly breakout attempt. The Vanguard Total Market ETF tracks global markets as a whole, also has a flattening out 200-day moving average. It would need to clear the recent daily closing high and stay above it to ignite a strong move to the upside, potentially to fresh all-time highs. That breakout would need to be above 163.36, which is this daily closing high. Take a look at the emerging market ETF, which had a flattening out 200-day moving average. It broke out above that range, so this is a classic example of what to expect and demand. So a breakout above this level led to a sharp day-to-day move higher on a swing trade perspective right here. And again, here we can anticipate a sideways to bullish market as long as we are holding above daily RSI lows. Now visually we have the example in the opposite direction. Here we had a flattening out 200-day moving average. We had a declining 50-day moving average. We had a breakdown below this daily closing low, and that breakdown, as you can see, led to a strong momentum push to the downside. And again, this is another example of what I call the Muathe Virgin Breakout, only that this time it was in the bearish sense. So timing was right here as you broke to fresh daily lows. One could have taken a bearish position in anticipation of a future bearish crossover between the 50 and the 200-day moving average. If we take a look at the ETF ACWI, which tracks global markets as a whole, we can see that there was a recent move above the recent daily closing high. Again, we have another instant of a flattening out 200-day moving average. We have a crossover now between the 50 and the 200-day moving average. We have clearance of that daily breakout. The daily breakout level was at 79.69. Again, as long as we're above this level, this is indication of a bias to the upside for markets generally, unless we fail and we end up trading below this recent daily closing level. Take a look at the Canadian market, and the only way we can have a bullish crossover between the 50 and the 200-day is by prices moving to the upside in a short, strong, continuous daily burst to the upside. In other words, a strong swing trade to the upside is what is needed. We can take this recent daily closing high as a gauge of market intent, and as long as we are holding above that daily level of 15,974.91, we can assume that the Canadian market is also setting the stage for a strong move higher. And of course, if this breakout fails, that in itself would be a bearish signal. Again, the only way the NIFTY, the Indian market, can show a crossover of the 50-day moving average moving above the 200-day down the road is by prices continuing to trade above this range, above the recent daily closing high. And that level, as long as it can hold above the recent daily closing high of 10,802.70, which is the recent daily closing high from July, as long as the NIFTY can hold above that level, it gives the market the opportunity to move higher in a strong, sharp move to the upside. Again, we can see that bearish example of the Muathe Virgin Breakout, where we have this daily closing low. You'd end up breaking below that daily closing low. Take note of where we have flattening out moving average. The 200-day was flat, while we have a coiling down of the 50-day moving average. So in other words, you'd be playing the potential crossover, a bearish crossover between the 50 and the 200-day moving average. Your entry was somewhere right there. And of course, the downside was very strong based on what is needed to take a flat moving average, which is the flat 200-day moving average. The only way to make it coil down, which is coiling down here, was with this huge move lower in price. So market pools right now need to insist that the NIFTY holds above 10,802.70 so as to increase the odds and potential for a sharp move to the upside, which is the only way you can now influence a flat 200-day moving average to coil to the upside. Now, if this does not make sense, I should have some videos under the playlist, the Muathe Virgin Breakout. If I remember, I'll put the link in the description of the video. This very video, that is. Let's take a look at crude oil, and it's been trading in a range, tight range. Let's say here from about early June, it's been trading in this range. So really, we can't write too much about it, especially given the fact that we are trading between a downward sloping 200-day and an upward sloping 50-day moving average. So because we are trading below those moving averages and they are all trading in different directions, it just means that this is a market that is range bound for now. So crude oil, in my opinion, continues to be range bound given the fact that you have the moving averages pretty much trading in the opposite direction, which is a sign of confusion, and we can see confirmation of this because prices have been in a range. So bulls would want to see a breakout above this range, while bears would be encouraged should there be a breakdown below this range. Bulls would want to see the RSI move above this declining RSI line, and at the same time bears would want to see a break of this wedge. So again, we can see the RSI is giving us a confirmation of sideways wedging formation. For there to be a move higher, we need to move above this range. For there to be a move lower in price, this would have to break to the downside. Let's take a look at gold by way of the GLD. As pointed out over the last couple of months, as long as GLD is holding above 69.1 on its monthly chart, there's only one option, which is to give it a benefit of the doubt to the upside. Again, as long as it's holding above 69.1, we have to give metals and gold the opportunity to continue higher because the setup is there with the strength on the monthly. GDX also this month has moved above 69.1, which also means that as long as GDX can hold and sustain its RSI above 69.1, this does favor a market that net over time is bound to go higher. Now, of course, if this was to fail to hold above that level, that in itself would be bearish. So again, just recognize this is the important takeaway for the metals. As long as we have GLD above 69.1 and as long as we have GDX holding above 69.1, this is still a market that has an opportunity to continue trading higher. Now, take a look at silver by way of SLV. And those of you who've been in the market long enough can remember this breakout in 2010. At the time, we caught this breakout nicely, given that it met the minimum requirements. At the time right here, this was a good breakout. And of course, those who took the breakout at the time had an opportunity of riding this massive move in silver. And pretty much that's the biggest move in this chart. We haven't seen a similar move. Now, one thing we can see from this chart is this level of the RSI has turned into a little bit of a problem. Once we broke down here, which coincided with this trend line break, we can see that this has turned into an area of resistance as far as silver is concerned. And so right now, this is the challenge. It would need to clear this level before silver can see a massive move to the upside. Keep in mind, our breakout entry point was when it moved above 17.15. So it needs to stay above 17.15, which is the monthly closing high from 2019. In terms of quality, we can see right now it does meet the minimum requirements for the ultimate Muathe breakout, as the RSI is essentially at 3-year highs. We can see at least one of the MACDs is trading at 3-year highs. So this is exactly what the silver bulls want to see, a continued holding above 17.15, because right now it meets the minimum requirements for a quality move to the upside. Failure to hold above 17.15, given the resistance I just discussed on the monthly, would be a sell signal. And finally, I'll take a look at the cryptos generally by taking a look at Bitcoin, and really it's been stuck in this range. Nothing has changed. Stuck in this range for many weeks, if not months. As we've established weeks and months ago, it would need to clear this range. It's 10,000 price range would need to be clear to the upside before we can see any momentum to the upside as far as Bitcoin and the cryptos are concerned. Right now, there's absolutely no momentum as the instruments are stuck in sideways action. Also, the weekly RSI would have to clear this range before it can continue moving higher. If you take a look at the daily, again, the same conclusion pretty much. Stuck in this range. You'd need to clear the 10K area before you can see higher prices. And we can see that the RSI is forming a wedge. So maybe if you're really insisting on finding some reason to trade this, a breakout above this range could ignite some action to the upside, and a breakdown below this range could ignite some selling in the short term. But again, because we are trading between the 50 and the 200-day moving average, it explains why prices are pretty much stuck in a tight, narrowing range. Can it explode out of this range? That's possible, but it would need a price movement in either direction. As we've discussed for many weeks, it would need price movement either below or above this range to influence the next move higher if it can clear that range. And for prices to go low, it would need to break below this range. All right, let me leave you here with a snapshot of the market at the conclusion of this options expiration week. Eric Muathe, Muathe.com. Love and light, light and love. Namaste.